We're going to jump straight into our special discussion this morning. We're talking about the Q1 GDP figures that have been released by the Nigerian Bureau of Statistics, which were actually released yesterday, Sunday evening. Nigeria's economy, of course, recorded growth of 0.51% in the first quarter of 2021. We have a special report on the GDP of Africa's largest economy. Let's take a listen.
In Nigeria, the National Bureau of Statistics yesterday announced the first quarter 2021 gross domestic products report, showing growth by 0.51% year-on-year in real terms for the first quarter of 2021. This marked 2 consecutive quarters of growth, following the negative growth rates recorded in the second and third quarters of 2020. The Q1 2021 growth rate was still slower than the 1.87% growth rates recorded in Q1 2020, however higher than the 0.11% recorded in Q4 2020, indicative of a slow but continuous recovery. In the first quarter of 2021, average daily oil production stood at 1.72 million barrels per day, or 0.35 million barrels per day lower than the average daily production of 2.07 million barrels per day recorded in the same quarter of 2020. Only last week, there was also yet another glimmer of hope, as the April inflation print showed a reduction to 18.27%, a lower monthly inflation growth for the first time in 20 months. In Nigeria, the economic news has been anything but cheerful. Analysts ponder a 33% unemployment rate, inflation at over 18%, with food inflation in some states over 30%, and an economic trajectory befuddled by the COVID-19 pandemic and security challenges. The present government inherited a fragile economy, which in 2016 saw 1.58% economic decline, improving to a maximum 2.27% in 2019, before succumbing to the impact of COVID and crash in demand and prices of crude oil. Average GDP growth at 0.31% from 2016 to 2020, as the population grew at over 2.5%, reinforces a tough scenario where GDP per person has been consistently falling since 2015. The World Bank forecasts that by the end of the year, real income per person in Nigeria, home to 1 in 6 of sub-Saharan Africa's people, will be at the same level as it was in the 1980s. On Tuesday, the nation's central bank, which has assiduously introduced monetary support and targeted interventions to support the agriculture sector and small-scale enterprises, is expected to keep the key rates unchanged. With inflation at double the top of its target range and the need to spur an economic recovery, the Apex Bank has a difficult job. Reform is desperately needed, but apparently very difficult to enact, talk less of execution. Oil reform has been stuck in a peculiar quagmire. Removal of subsidies for petrol is seen as inevitable, but when and how remains less clear. The government passed in July 2020 a Nigeria Economic Sustainability Plan in response to the COVID-19 pandemic. However, projections are still far from the 6% growth needed in the medium term to tame the poverty. Still on poverty, the Federal Executive Council last month approved the National Poverty Reduction with Growth Strategy, NPRGS. This is a strategy for accelerated reduction in poverty through economic growth, redistributive programs, and shared prosperity. The NPRGS, designed by the Presidential Economic Advisory Council, will support the goal of lifting 100 million people out of poverty within a decade. Apart from declining inflation, the good news is that better oil prices and volumes this year could ease the shortages and boost government finances. Analysts, however, fear decent oil prices may, as we've seen in the past, reduce the urgency and pressure to fix the deeper economic cracks, requiring more structural responses.
Right, more structural responses. For more on this special discussion, we have, of course, in the studio with us, Mr. Tilewa Adebajo, CEO, CFG Advisory. And any moment now, we should have Mr. Johnson Chukwu, CEO of Cowry. Well, there he is, Johnson Chukwu, CEO of Cowry Asset Management, also with us as well. Gentlemen, thank you so much for joining us. Tilewa, we'll start with you. As far as this 0.51% growth is concerned, was it in line with your expectations?
Yes, I think definitely. I mean, if you take a look at the trajectory of growth coming out of the recession, last year, from the lockdown and the pandemic. Pre-pandemic, the economy has always been fragile to start with anyway. So basically, we're just recovering and we're getting back to the growth we were seeing pre-pandemic. So I think this is definitely in line with expectations. So the challenge now is that we're coming out of a recession and then we're going into a situation of stagflation.
Fantastic. And thank you so much, Tilewa. Mr. Johnson Chukwu, are you with us? Fantastic. I wanted to ask about and let's put up this oil contraction. If you look at the contraction of the oil sector, 2 consecutive contractions now, 2.21% in this quarter, 19.75 in the last quarter, oil contraction. Surely an improvement. What do you make of what's been happening in the oil sector?
Okay, thank you, Rotus, for having me. The key thing we have to recognize is that the oil sector contraction is now driven largely by OPEC plus restrictions. If you look at the improvement you saw to production of 1.72%, 1.72 million barrels per day, you have to factor in the fact that our production quota is about 1.4 million barrels per day, or I think 1.48 million barrels per day, and our condensate, which does not count as part of the OPEC quota, is about 300,000 barrels a day. So the oil sector could have done better than what it's currently doing, if not for the restrictions we've had. But that is partly compensated by the increase in crude prices. So we have to live with this restriction until global demand recovers fully and OPEC and OPEC Plus improve our quota.
Thank you so much, Johnson. Tilewa, let me come back to you. We continue to talk about, let's put up oil contribution to GDP. The oil's contribution, I think it was at 9.25% for the first quarter. Yes, 9.25%, up from 5.87 Q4. We continue to talk about how this sector only contributes less than 10%, yet is responsible for so much of our FX income. Will that ever change? We have this conversation again and again each time these numbers come out.
Well, I don't think that's going to change that much until, of course, you see the trends in the global markets whereby there's a de-emphasization on fossil fuels. Most Western countries have a plan to go into electric cars, and of course, the use for oil is going to come down. So we've had that problem. But more importantly, the problem in Nigeria is the fact that 44 years ago, in 1977, we were producing 2.5 million barrels of oil. Since then, 44 years ago, we've not been able to exceed 2 million. We've been struggling. So what that means is that we haven't even been investing in that sector. We have an $8 million investment in Train 7 for the LNG. So gas is big. We have OK LNG and all these other gas projects I think we need to look at, because those are more of the sustainable energy requirements for the global markets in the future. So it's important that we begin to invest in the gas sector and de-emphasize oil.
Thank you so much for that, Tilewa. Johnson, I want to come back to you. I want to look at the non-oil sector now. We take a look at the non-oil slowdown with respect to the drivers of non-oil growth. I want to get your take on, here it is. So ICT fell to 6.31% in Q1 from 14.7%. Human health, social services, okay, that improved, but manufacturing also improved. Agriculture, though, was down. So was real estate. What's your take on the slowdown we saw in the non-oil sector as far as these drivers are concerned?
We have to recognize the contribution of each of these sectors, which was why we saw a decline in the non-oil sector growth, from about 3.42% to about 2.28%. If you look at the fact that the ICT sector accounts for about 15% of the GDP and contracted from about 14.95%, which is what they reported in Q4 2020, to just about 6% in Q1 2021. That took a weight of about 15% of the GDP. And then look at the agricultural sector. The agricultural sector accounts for 22% of the GDP, about 22.35% of the GDP. It also contracted from 3.42% to 2.28%. So if you look at those two factors and consider that the sector that accounts for about 37% of the GDP contracted. So that's what drove down the contribution and the performance of the non-oil sector. I mean, you saw the non-oil sector, of course, contribution improved to 90.75%. But in terms of growth, we saw a contraction in the growth of the non-oil sector. And for me, that should be of concern to us. Granted, the manufacturing sector improved, and the manufacturing sector accounts for the highest number of employment in the country. But IC sector is also a critical sector that we must ask ourselves, why is it contracting? Because it has been a sector that has consistently grown. The manufacturing sector accounts for the largest share of our employment, but it's contracted despite all the stimulus of the central bank and the government. And I think that has to do with the level of instability or increased level of instability in the country, that it's dislocating farmers from the farming into IDPs. So we need to address those factors. Otherwise, if the non-oil sector begins to constantly contract, the economy could actually tip back into a recession.
Thank you so much for that. Let's look at the non-oil contribution to GDP. Let's pull that up for our viewers. Tilewa, actually, this is now the reverse of the prior question that I asked you on oil. So now we're looking at non-oil sector contribution to GDP. It fell, 90.75% Q1 from 94.13 in Q4 2020. So the reverse, how is it that you've got a sector contributing over 90%, but doesn't contribute as much FX as oil, and can that change? That's essentially the same question.
I mean, that is the dilemma for Nigeria. And I think we're talking about exports. And basically, we've not been able to strengthen all the export incentives that we put in place. Obviously, I think we need to relook at that, because we're focusing mostly on oil exports. We're looking at non-oil exports. Are we able to strengthen our manufacturing sector? The African Continental Free Trade Agreement is coming into play. We even have AGOA. Are we even setting up manufacturing to even export to the United States? Are we exporting agricultural produce into Europe? I mean, countries like Kenya, Ethiopia, even the Ivory Coast, they're very big on even fresh cut flowers and all kinds of commodities because they don't have oil. So they're dependent on a lot of other non-oil products to be able to generate the foreign exchange they need, including tourism. So this is the Dutch disease that has plagued Nigeria for years. And unfortunately, this whole essence of diversifying the Nigerian economy, we still have not attained that. And when you have a recession, and we're going from a recession into stagflation, and we do not have the buffers to be able to manage these shocks, I think these effects become more pronounced.
Thank you so much for that. Okay, I think we're going to take a break any moment from now. Again, we're talking about the Q1 2021 GDP figures for Nigeria, 0.51% growth from 0.1% in the fourth quarter. We're speaking with Tilewa Adebajo, CEO of CFG Advisory, and Mr. Johnson Chukwu, the CEO of Cowry Asset Management. When we continue after the break, we're going to talk about the African Continental Free Trade Agreement, which Tilewa just mentioned right now, the big three sectors, what we can reap from the AFCTA, plus more after the break. Do stay tuned. Welcome back to the Global Business Report on Arise News. We continue the discussion on the economic growth for the first quarter of Africa's largest economy, Nigeria, 0.51% in Q1 2021 from 0.1% in Q4. We have, of course, our special guest, CEO of CFG Advisory, Mr. Tilewa Adebajo, also CEO of Cowry Asset Management, Mr. Johnson Chukwu. Mr. Johnson Chukwu, I'm going to come to you now with this next question. The big three, as far as the big three contributors to GDP in Nigeria, services, agriculture, and industries. What can we reap in terms of the African Continental Free Trade Agreement from what you're seeing from the three sectors?
Okay, in the first place, if you look at the structure of the African Continental Free Trade Agreement, it basically says that goods manufactured in any of the countries that belong to the AFCTA can easily move to any other country and without any customs barrier. So it then means that our focus in that area will be on agriculture and industries. If you further decompose these figures of agriculture and industries, like you rightly pointed, agriculture accounts for about 23.35% of the economy, of the GDP. Then the next to it is trade, which accounts for about 15.6% of the economy. Then you move on to telecommunication, about 14.9% of the economy. And then you move to manufacturing, about 9.9% of the economy, and the oil and gas sector, about 9.25%. But the key thing for me is that what do we need to do to improve on the value chain or the value addition of what we call beneficiation of these sectors that contribute significantly to the economy? Agricultural sector, we are still producing the raw food items. We need to get to a point where we have processing plants where we turn these raw food items into some semi-finished products so that we can export them to other African countries. Like cassava, for instance, into starch and other byproducts oil leading to refined margin and other products which export to other countries. That benefication must take place. The oil and gas sector accounts for about 9.25% of the economy. The downstream and the midstream sectors of that economy are non-existent today. We are not refining any products so that we can export them to other countries in Africa. Then look at the other sectors, the manufacturing sector. Granted, the manufacturing sector is increased. Of course, the cement sector accounts for about 11% of the manufacturing sector, and the beverage sector accounts for about 7%. I mean, grew by 11%, the cement industry sector, and then food and beverage about 7%. So those sectors, we need to incentivize them further so that they can produce more to export to other African. That's the way we can take advantage of the African Continental Free Trade Agreement, by building on those sectors where we have competitive advantage: agricultural sector, the manufacturing sector, cement industry, food and beverage sector. Then I had mentioned trade. Unfortunately, most of the trade activities going on, either we're distributing local food items, or we're selling imported food items. When we improve in the manufacturing sector, that we improve on the value chain in the country so that we can take full advantage of the African Continental Free Trade Agreement.
Thank you so much, sir. So, Tilewa, I want to come to you on an issue that's been on the front burner in the country now, which is open grazing. We had a statement from Mr. Tanimu Yakubu, who is the former special advisor on economic matters to former President Yakubu. So, former President Yar'Adua. And so, the economic impact of this matter of open grazing. He said in his statement that open grazing results in about 90% destruction of vegetation cover. So I want to get your thoughts on his statement that he put out and this whole issue with open grazing.
First of all, I think it's important for us to understand that the Americans have landed a rover on Mars. And quite recently, the Chinese also just landed another rover on Mars. So in this day and age, talking about open grazing and not being able to understand a tried and tested methodology for animal production of livestock, I think is a problem. And I think, as you rightly pointed out, it's a massive impact on the climate. You destroy the soil cover and people cannot farm. So he's hit the point on the head, because at the end of the day, this is actually quite a destructive process. But I think I was on the Arise Morning Show the other day when we talked extensively about a new method of livestock, and where we had looked at several proposals that we had presented on how to get this thing done. Brazil, the United States, it's $1 billion business, and they're exporting. So you're talking about exports.
Right.
I mean, this is a big opportunity for us to be able to organize our livestock industry and begin to do that. For instance, in Lagos, they're slaughtering about, God knows, 10,000 head of cattle a day. I mean, that's about $1 billion. That's about 300, 400 billion a year in Lagos alone, as it is with an unstructured market. So the business potential from that area is very, very important. So it's important that the central bank begin to look at intervention programs that it can use to attract investments into this livestock sector for us to be able to realize the potential. It's not open grazing. It's a business that is industrial. It's an industry with factories. It's a factory process.
Thank you so much, Tilewa. Johnson, I want to come back to you. The MPC, Tilewa just mentioned the central bank and incentivizing the livestock sector. Central bank, of course, done a lot in the Anchor Borrowers program. And crop production, by the way, was the largest performer in the agri subsectors. But I want to ask you about the MPC meetings. It kicked off today. The decision will be shared with us tomorrow. Do you think inflation, this GDP figure, how do you think that will work its way into the MPC decision that we get tomorrow?
Yes, absolutely. I expect the MPC to consider the fact that we've had two positive news on the economy. We had a slowdown in inflation from 18.17% to 18.12%. We also saw an improvement in GDP growth rate from 0.11 to 0.51%. But both positive changes are still very fragile. I mean, a decline of just 0.07% on inflation is not enough for anybody to say, okay, let's loosen, because if you loosen, there are a couple of things that will happen. You will see further pressures on your FX. You will also see a reversal of the slowdown in inflation rates. Then at the same time, a growth of 0.51% is still very fragile for you to also say, look, at this point, we need to fight inflation by pressing on removing our legs from the pedal. And that is adopting some contractionary measures to fight inflation. So we are at a point where the central bank still have to do with what the CBN governor called policy dilemma, trying to balance growth and at the same time moderate inflation. So I think the most appropriate decision they would take is to hold rates at current level because they can't afford to move in another direction.
Thank you, Johnson. Tilewa, same question to you. What do you expect?
Well, yeah, I mean, I accept, just to develop further what Johnson had said, I think my expectations, obviously, are that they'll have to hold rates, but I'm looking at it from a different perspective. We have about 10 trillion, which is about $25 billion of ways and means financing that is also putting pressure on the system. And the Debt Management Office has announced a program to refinance this ways and means off the books of the central bank with 10 to 30-year bonds. And it's important to see how this ways and means funding is coming into the financial markets. Because first of all, we're going to see a situation whereby public borrowing is going to start crowding out private sector borrowing. And of course, the issue of rates. Government is using close to 85 to 90% of its revenue to service debt. So government itself cannot afford higher rates at the moment. So I think that is another area that is driving that. Inflation, I believe the central bank has a handle on inflation because, I mean, inflation went up to 19% before and they brought it back down to 11. But it just seems to me that once inflation gets to 11, I don't know what the magic is with central bank. They don't seem to be able to just get it down to the single digits and it goes back up again. But I think they have a handle on inflation. And I think the focus now should be on the growth of the economy because, as they said, the growth is fragile. There are green shoots. But we need sustainable policies, which is more of the restructuring and the fiscal discipline. I think we should start looking at the implementation of the Rotus Oddiri report because monetary policy, in fact, has reached its limits because I don't think the central bank can put any effect. So we need to focus on the finance ministry to see how they can implement the Rotus Oddiri report and government to cut its expenditure. And we shouldn't forget that the NMPC has already warned that they are not going to be able to sustain revenues into the Federation account for the next 3 months. So that is also going to put some pressure. How are they going to fund it? Our debt profile has gone up to $115 billion. And that in itself is a red flag. And we need to start watching and putting a slowdown on these borrowings.
Thank you so much for that, Tilewa. I wanted to get to debts. It's such an interesting conversation. We'll leave it there. Tilewa Adebajo, CEO of CFG Advisory, Mr. Johnson Chukwu, CEO, Cowry Asset Management. Thank you so much for the conversation, in-depth conversation on Nigeria's Q1 GDP and what we expect at the MPC meeting tomorrow and so much more. Thank you, gentlemen, so much.